What are the tax implications of a CCRC contract? If you are considering a continuing care retirement community, you might be wondering about the tax implications of the contracts involved. Understanding these details can help you make informed financial decisions. Continuing care retirement communities typically requiring an upfront entrance fee along with ongoing monthly fees. The tax treatment of these fees varies based on the type of contract you choose. For example, Type A or life care contracts usually have higher fees but include most health care services at little or no additional cost over time. Since these contracts prepay for future medical care, a portion of the fees may be treated as prepaid medical expenses by the Internal Revenue Service. This means that part of what you pay could potentially be tax deductible. However, the deductible portion is not determined by how much medical care you actually use. Instead, it is based on the percentage of the fees that the continuing care retirement community designates as related to medical care, such as nursing or medically necessary services. Each year, residents should receive a statement from their continuing care retirement community that specifies what percentage of their fees is considered medical and thus potentially deductible. To take advantage of these deductions, the total qualified medical expenses, including the deductible portion of the continuing care retirement community fees, must exceed 7.5% of your adjusted gross income. Only the amount above this threshold can be deducted on your federal income tax return. It is also important to note that Medicare generally does not cover long-term care costs associated with continuing care retirement communities, except for limited skilled nursing care for up to 100 days. This lack of coverage makes it even more important to understand how the fees are treated for tax purposes as part of your elder law or estate planning. Different contract variations can also affect tax implications. For instance, some continuing care retirement communities offer equalized rate contracts, where monthly fees for healthcare services may change based on your original living unit and usage. This variability can impact how predictable your tax deductions are. When planning for elder care, it is essential to review the specific continuing care retirement community contract to understand the fee structure and the percentage of fees that may be deductible. Coordination with financial planners and elder law attorneys can help you optimize tax benefits and ensure that your contract aligns with your long-term care and estate planning goals. Lastly, keeping proper documentation of fees and the medical expense percentages is necessary to support your deductions on tax returns. Understanding the tax implications of continuing care retirement community contracts can help you manage costs and benefit from available tax deductions.